Great. I'm Samantha Rowan, and this is Refi TV. Today's guest is Matt Anderson. Matt is a partner at Foresight Analytics, which focuses on analysis and forecasting for commercial and residential real estate. Thank you for being here today, Matt.
Thanks. Good to be here.
Now, when you and I first started talking a couple of years ago, it was when you began sending us research from Foresight about banks and bank performance. You publish a watch list of banks that might be at an elevated risk of failing. How do you gather and analyze this information?
Well, the basic data that we get is from regulatory filings. So it's actually publicly available data that's the fundamental basis of what we do, but then we add a lot of proprietary analysis on top of that. We produce an array of risk metrics on banks, and the watch list itself is the result of one set of analysis, again, proprietary results that really are from the experience that we have in modeling commercial real estate debt in particular.
How accurate have your watch list been so far?
Well, pretty accurate. We've caught 306 out of the 316 banks that have failed in what we call the current cycle that started in September of 2007. So that's 97% of the failures have been on the watch list at least one quarter prior to failing. And actually during 2010, that's lengthened out. So we've been catching banks earlier on in the process. So for 2010, actually at least 4 quarters typically in advance.
Oh, that's pretty accurate.
Yeah, we think so. And actually for the 10, we've tried to focus on the 10 that we missed and to try to figure out what went wrong there. And we've made a few adjustments to our model since then to try to catch more banks that are at risk of failing.
Now, when you're doing your analysis on bank performance, how much of an impact do commercial real estate loans have on what's going on?
Well, commercial real estate lending is very significant for banks. In aggregate, it's about roughly 25% of bank lending overall, 1.6 trillion currently of commercial real estate debt that's outstanding on bank balance sheets. So we actually have roughly 1,000 banks that have what would be considered a commercial real estate concentration as of the third quarter. That's down from previous quarters, but that's still a very significant figure. For the watch list banks, or for the banks that are at risk of failing, it's even more significant. It's roughly 80% of the main problems for banks on the watch list. That figure has shifted over time, or the composition of the commercial real estate exposure has shifted over time to the point where construction lending has really been the main driver behind bank distress and bank failures. But commercial mortgages themselves, so longer-term commercial mortgages on income property and to some extent on owner-occupied property, have also become problematic loan types. That ratio for our watch list has increased. It's about 5% of the problem back in 2008. That increased to 17% at the beginning of 2009. And now in the third quarter of 2010, it's 34%. So, and that trend has been continuing upward steadily each quarter.
That's quite an increase. And another area of your business that we've spoken to in terms of your analytics is related to mortgage maturities. When do you see commercial mortgage maturities reaching their high point?
Well, commercial mortgage maturities are something that we've focused on for at least the last couple of years, and I think the industry has been very focused on the issue. The mortgage, commercial real estate debt market doubled in size between 2000 and 2007. There was really a glut of issuance, especially at the peak in 2006 and 2007. Those problems or issues are coming home to roost now, so that really boosted or set up this wave of commercial mortgage maturities, as this graphic shows, that really jumped up in 2008. The volume that we see coming due every year is on the order of 300 billion, in excess of 300 billion this year and next year, and it won't peak until 2013 at about 370 billion then. And will come down a bit, but still will be elevated through 2017. Again, just as the result of all the issuance that was going on during the boom.
And this is CMBS issuance and other kind of mortgage origination.
That's right. It combines everything. So CMBS and bank lending would be the two main types. Life companies are another significant source. And then on the multifamily side, Fannie and Freddie
course.
are big lenders there too.
Of these mortgages, how many are underwater? Have you guys been able to do analysis on that?
Yeah, we've plugged in some figures on to try to come up with a rough estimate of where loan-to-value ratios are now. And unfortunately, our calculation is that a little over half of the mortgages maturing over the next 5 years are currently underwater. So that's a significant figure. Roughly 900 billion, a little over 900 billion, by our calculations, is currently underwater. That may not be. Some of that may not be very underwater. So the loan-to-value ratios could be right around 100%. So if values increase, we've also modeled in a couple the impacts of some price increases. If prices increase 10%, for example, that figure would go down to about 36% of the mortgages, of the debt maturing over the next 5 years that would currently be underwater. And with a 20% rise, which would be very significant, the issue won't go away, but it would be reduced to about 16% or so of the debt maturing. So still a very significant figure, but not quite the astounding half or more of the market that we're currently looking at.
So is it your sense that we've seen the worst part of the crisis in terms of underwater mortgages that are coming due, or is that going to be down the line in 2012, 2013, 2014?
Actually, the worst is yet to come. So we've seen some problems already, and some of the mortgages that have defaulted already are for those subsequent year maturities that have already hit problems and gone into default. But by our calculations, there's actually a rising proportion of debt that's maturing that is underwater. So in 2011, that'll increase to about half of the debt that's maturing in 2011 that's currently underwater, and then actually over 50% as we move into 2012 and 13 and 14. And again, that's absent a rebound in prices from where we're at now.
And also, I imagine there'd need to be significant movement on the lending side to kind of come in and get these loans refinanced and get them moving again.
Well, yeah, so that's where the whole loan extension issue came up. Really, in 2008, loan extensions became a major factor in the market, or major trend in the market. Really, I think initially it was viewed as a short-term survival technique. It's become not exactly routine, but much more common. By our own estimates, roughly 60% of the debt maturing each year for the last few years has been rolled over into additional extensions granted. By other people's analysis, I've heard similar figures from other folks. I don't think we're alone there with that roughly 60% figure. And I should add that's not really factored into the figures that we have on annual mortgage maturities. So for example, in 2013, the $370 billion that we're estimating will be coming due in 2013, it doesn't include prior year extensions. So if you add that in, there's really an increasing amount of pressure being put on the market, or the need for credit in the market as we move forward. That really, it's sort of issues from prior years that haven't exactly been dealt with, or haven't fully been dealt with. And really, on one level, there's sort of hope notes that that prices will be better, and underwriting, traditional underwriting, can be used then to refinance mortgages that are coming due. I should add another factor or element in the mix is the very low interest rates that we currently have actually enabled this process, made it easier to extend, both because it's reduced payments on variable debt mortgages. So debt payments are easier to handle, even if the property is upside down value-wise. Cash flow may be sufficient to keep making debt service payments, and as a result of that, the borrower can hold on, and the lender, in a low-rate environment, the lender really has nothing to lose by extending that loan, and sort of everything to gain because they avoid taking losses on that loan. But it remains to be seen if we enter a rising rate environment, that could change very dramatically. So you could have lenders that are being penalized for rolling over mortgages, and they could be disincentivized to keep granting extensions. So the music might stop there, but remains to be seen where the pressure points end up as we move forward.
definitely going to be an interesting market over the next couple of years to cover.
Definitely, yeah. And we have a really sort of a barbell or bifurcated market as we describe it right now, with a lot of activity at the upper end, a lot of trophy properties or institutional grade property, core properties are trading at relatively healthy multiples. But at the other end, there is current distress, a large amount of current distress out there, and then we think coming volumes of distress as we move forward.
Now, to shift gears a bit, Foresight is a part of Trepp. How do you incorporate Trepp's data and statistics on commercial mortgage-backed securities into your analysis?
Well, really sort of two ways. One at a higher level, where we're taking some of the experience and analysis that Trepp has done. One example being on the commercial mortgage market, analyzing loss given default. We've actually used some of those figures that Trepp has produced and updated our bank lending model or our bank loss model as a result of that. And then also at a more micro level, we've done some work in the past on modeling individual mortgages, and Trepp has a vast amount of data on every loan in the CMBS universe. And actually, CMBS data is very significant. At the peak, it was roughly 50% of net new volume in the market, and currently it amounts to about 20 or 30% of the debt outstanding, commercial real estate debt outstanding. So it's a large figure in and of itself. So really studying what's going on in the CMBS market is very instructive for the rest of the market, where there's not as much transparency or data that's available.
Yeah, that's one of the things that I've always been told about the CMBS market, that just the transparency is very helpful for people doing analytics on the commercial real estate sector.
Yeah, it's tremendous. I mean, you've got everything from a very, down at the loan level and property level on up through, market statistics, market by market and product type, by loan vintage, origination vintage year, by loan maturity, and then the entire market. So there's a lot of analysis that one can do. We've done some, but we've actually really only hit sort of the tip of the iceberg so far, I think, in terms of what we've been able to produce from it.
Yeah, it's all good stuff. And so we've talked about some scary stuff here today. What good news are you seeing in today's market?
Well, probably two things. One being that there is definitely a lot more liquidity in the market now than there was 12 to 18 months ago. At that point, the markets, global credit markets had seized up, and in commercial real estate was certainly not immune from that. So, there is more deal flow going on, and there is more liquidity. CMBS, for example, is making a comeback. There's a little over $10 billion in issuance, I think, for 2010, and we're headed into most likely a bigger year in 2011. So that's a positive, but it's easy to forget that that's still a far cry from where we were in 2006 and 2007. So there's still a lot of healing that needs to go on that front. One other positive that we see is that on the bank side, banks have been writing down their problem loans, and that's enabled banks to clear off some of the problem loans from their balance sheets. There's still a lot of room to go there, and again, it differs bank by bank, but for the sector overall, there's still a lot more work ahead. But some progress has been made, and very notable progress just in the last few quarters. And then I think probably the biggest plus in the market is that even though we have weak fundamentals now, some of the trends are strengthening on the lodging front and multifamily. There's a lot of excitement that or pockets of improvement in certain markets and certain segments of certain markets. So you can't generalize too much, but there are some pockets of improvement. And overall, the economy we think is headed in the positive direction. It's a lot less and a lot slower than we or everybody would have hoped, but those are definitely positive elements. And as we move into 2011 and 2012, we expect that momentum to build up, and that real estate demand is definitely economically driven. So those positive indicators in the broader economic environment will certainly have an impact on market fundamentals and strengthen the market.
Great. That's good. That's good to hear some good news finally.
Yeah. We're so used to saying bad, negative things. It's we're taking us some time to shift our mental focus as well.
Yeah, absolutely. And so that's all the time we have for today. Thank you for being here, Matt.
Well, thanks very much. I enjoyed it.
And I'm Samantha Rowan, and this is Refi TV.